In this video we will go over the types of instruments one can trade, explaining what a CFD is, margin leveraged effects, and key terminology you need to know as a trader. What you trade largely depends on the broker you choose. With our preferred broker you could trade foreign exchange, spot and futures. You can trade commodities, spot and futures, such as gold, silver, even copper, crude oil, natural gas, coffee or sugar, and many more. You can trade major stock indices around the world, and interest rates, that's all the major government bond markets and short-term interest rates. Some of the instruments you trade depend on the type of market. For foreign exchange, most brokers will offer spot or future over-the-counter contracts. For anything else, you'll be most likely trading a CFD, which stands for Contract for Difference. Now don't worry, we will explain these terms in more detail in a moment. All of these instruments are leveraged or margined. But what does that mean? Most brokers will offer you between 100 to 1 to 400 to 1 leverage.
That means in the case, for example, of 100 to 1, if you have $1,000 in your account, you can take a nominal position of $100,000. In the case of 400 to 1 leverage, that means that effectively you can take a $100,000 position with $250 in your account only. Now, when you trade with leverage, there is a margin requirement in your account. In the case of 100 to 1 leverage, that equates to 1%. So in the example above, you must have at least $1,000 net cash in your account in order to be able to take a position of $100,000. Now this is good news because it means you don't have to have massive amounts of cash in your account to trade decent size. But this doesn't mean that you are risking less. In fact, you must really take note of this. Trading with leverage is a high-risk way to trade. You can actually lose more than what's in your account, and we will explain this in a lot more detail in this mini-series. Now, we want you to be very aware of this risk, but at the same time, don't let it put you off trading. This risk can be mitigated and controlled effectively by applying sound and simple risk management techniques, which you will be able to learn with us. Now, we've started throwing some market terminology at you already, so let us try and explain some of it as we go along in order for everything to make a bit more sense. We mentioned the rolling spot contract. The spot market in a security is the currently quoted price, not a future price. In other words, the price as it is right now. Any open spot position is rolled over at the close of the day for funding reasons. There is a future contract. Now, this is a contractual agreement to buy or sell a particular commodity or financial instrument in the future at a predetermined price. Now, usually these contracts expire in March, June, September, and December, although in some contracts you may get some slightly different rollover dates. Let us now explain what a contract for difference is, otherwise known as a CFD. CFD is a contract between the market maker and an investor on an underlying security, like for example a commodity or a share. This means that a buyer will pay to the seller the difference between current value and its value at contract time. If the difference is negative, then the seller will have to pay the buyer. In other words, if you buy a CFD in, say, Apple, a share, the market maker gives you a price, which you deal on. Then if the price goes up in time, when it comes to selling, the market maker then owes you the difference, that is your profit. If conversely the price has gone down, then you owe the market maker the difference, which is your loss. It trades on a margin, so less capital is invested, as we described in the earlier slide. It allows you to go both long and short, which some securities cannot do. Now, a very interesting characteristic of the CFD is that it bears no ownership. That is to say, if you buy a CFD in, say, a share, you don't actually have voting rights for it. And at the same time, for example, you don't have to pay stamp duty when you buy it. But you do get the dividend, which is a very important thing to remember. Finally, let us not forget that it is a higher risk instrument because it is a leveraged instrument. So tight risk management is needed, and this is where definitely TFF can help. Long or short, we mentioned these terms as well. Going long is quite a simple concept. It just means that you're buying an asset whatever, gold, currency, expecting its price to rise so it can be sold for a profit. That's easy enough. Now, what about selling short? Some people struggle with the concept of selling short. It actually is not that difficult. It means selling an asset you don't own, expecting its price to fall, so it can be bought back cheaper for a profit. Now, the best analogy that I've heard to describe this concept is this. Imagine your next door neighbor has told you that he's looking to sell his motorbike and he'd like £4,000 for it. A few days later, you meet someone in the pub who coincidentally tells you that he's looking for exactly the same bike and is willing to pay £5,000 for it. Now, you tell him you have one just like it in your garage and you immediately sell it to him at £5,000. Then you rush home and you go and buy it from your next door neighbor at £4,000. It's not a great lesson in neighborly etiquette, but hopefully now you have a better understanding of what going short means. In some cases, because you're effectively selling something you don't own, you might actually need to borrow it, but it depends on the actual asset in question. Now, there are, of course, a number of terms in the financial markets that some of our viewers will not be familiar with. We can't, unfortunately, explain them all as we go along. So while you're watching our videos, if you have any issues with any of the market terminology, go and download the glossary of terms that you can find under our Trading Academy or useful links in our website. Thank you for listening, and see you in the next video in the mini-series.